Imagine finding your dream home, picturing yourself living there, but then realizing you don't have the massive amount of money needed to buy it outright. Most people don't, and that's where a mortgage comes in. A mortgage is essentially a loan specifically designed to help people buy homes. Instead of paying for a house up front, a bank or lender gives you the money, and you agree to pay it back over time, usually with interest. This arrangement makes homeownership possible for millions of people who would otherwise never be able to afford a home outright. When someone decides to buy a house, they usually go to a bank or a mortgage lender and apply for a loan. The lender looks at a few key things to determine whether the person qualifies. They check income, credit history, existing debts, and how much money the person can put down as an initial payment, known as a down payment. The higher the down payment, the less money needs to be borrowed, which can make the loan easier to get and cheaper in the long run. If the lender approves the application, they agree to lend the buyer the money needed to purchase the home. The buyer then makes monthly payments that cover the loan amount, interest, and sometimes property taxes and insurance. Interest is a major part of any mortgage. It's the cost of borrowing money and is expressed as a percentage of the loan amount. The interest rate can be fixed, meaning it stays the same for the life of the loan, or adjustable, meaning it can change after a certain period. Fixed rates provide stability because the payment amount remains predictable, while adjustable rates may start lower but can increase later, potentially making payments more expensive. Interest rates are influenced by factors like the overall economy, inflation, and the borrower's credit score. Mortgages come in different lengths, with 15-year and 30-year terms being the most common. But some lenders also offer 10-year, 20-year, or even 40-year options to fit different financial needs. A 30-year mortgage spreads the loan over a longer period, making monthly payments lower, but because of the extra time, more interest is paid over the life of the loan. A 15-year mortgage has higher monthly payments but costs less in interest overall because the loan is paid off faster. Choosing the right loan term depends on what a person can afford each month and how quickly they want to be debt-free. One of the most important aspects of a mortgage is the monthly payment, which consists of several parts that determine how much a homeowner pays each month. This payment typically includes four main components: principal, interest, taxes, and insurance. The principal is the actual loan amount being paid back. Interest is the lender's charge for lending the money. Property taxes go to the local government, and insurance protects both the homeowner and the lender in case of unexpected events like fires or other damages. Some homeowners also have to pay private mortgage insurance, or PMI, if their down payment is less than 20% of the home's value. This insurance protects the lender in case the borrower stops making payments. If a homeowner stops making mortgage payments, the lender can take back the home through a legal process called foreclosure. Foreclosure happens when a borrower falls too far behind on payments and can't catch up. The lender then sells the house to recover the money still owed. This can be devastating for homeowners because they lose their property and any money they've invested in it. That's why it's important to understand mortgage terms and ensure monthly payments are affordable before taking on such a big commitment. Over time, as a homeowner makes payments and the market value of the home fluctuates, they gradually gain ownership through a process called building equity. Equity is the difference between what a home is worth and how much is still owed on the mortgage. The more payments made, the more equity built. Homeowners can use this equity to take out loans for home improvements, emergencies, or other financial needs. A mortgage is one of the biggest financial commitments a person will make in their lifetime, so it's crucial to research, seek professional advice, and choose the right option carefully. Understanding how it works can make the process less intimidating and help homeowners make smarter choices. By choosing the right loan, managing payments wisely, and planning ahead, a mortgage can be the key to owning a home and building a secure financial future.
Got a question about how something really works? Drop it in the comments and we might cover your topic in our next video.